the first up, we're going to talk about savings and budgeting. So what is budgeting? Budgeting is having a financial plan. So budgeting is having a financial plan for a defined period, often 1 year, right? I typically, when I do my own budgets, try to look at like how much I think I'm going to have for income for the year and some type of expected expenses, the hope that you're going to be in the green, right? That's what you want to do. You want to be in the green or the black, depending on how you look at it. So in a business, it looks at volumes, revenues, all these other things, but really typically for us, it's just what we have, what we make or bring in for income, and then what we spend. And then what is savings? Savings is key. Savings is how much is left after you have all your money brought in, and you've done all your expenses, right? And how much can you save? So the difference between being comfortable and not is right. It's called savings. And you can hear it a lot of different ways. Our company uses like a financial planner group called Smart Path, and they call that fuel. They say fuel is the difference of what you bring in to what your fixed expenses are, or your non-fixed expenses, right? Your rent, your gas, your food. The fuel is what you have left, and that's what you can actually burn, right? So that's why they kind of call it fuel. So next, we're going to talk about, so we, in one of our groups, we were talking about this Dave Ramsey, right? And he has what he calls Financial Peace University. It's actually biblically based, right? The principles. And one of my favorite books to read is The Richest Man in Babylon. I typically read that book the beginning of every year, right? And it goes into kind of saving principles. And it's a very quick read. It's a very small book. And it kind of sets my mind frame for the year to come, right? And trying to save and plan. So in Dave Ramsey's philosophy, right, he has what he calls the baby steps. And so I see in the chat, is that a Christian book? It's actually not. The Richest Man in Babylon. It's really, that one is really not a Christian book. Dave Ramsey, although a lot of his principles are biblically based, it's like the tools can be applied no matter what religion you believe in, right? So it's some basic tools. So step one is have an emergency fund, right? So you always want to have at least $1,000. And I know that might seem like a lot. And then for some, it seems like nothing. But one thing I learned is the more you save, the easier it is to save. The more you spend, the easier it is to spend, right? So what you focus on improves. If you focus on saving money, you'll find that you save more money, no matter how much you have, no matter how much you bring in. That's why there's stories of these people who were like cleaning ladies for all these years, never had 401ks, never had a retirement. And when they died, they left universities $1 million, or they left charities $1 million, right? It's the fundamental of having more and keeping more than what you actually spend at the end of the day. Then step two is the debt snowball. So the debt snowball basically says you're going to pay off the smallest that you have first, and the impact of that makes it go bigger into the snowball. So some people say, well, you pay your highest interest. There's all these different philosophies that at the end of the day work. But in this one, he's saying, pay the smallest expense you have first, because you get traction, you feel accomplishment. It's one less thing on your plate. It's one less deadline. It's one less reminder, right? So you pay your smallest things that you can tackle first, and then you work your way to the big ones. Next is having a fully funded emergency fund. So that would be having 3 to 6 months expenses, and they say the average person does not have that. They can't go, a month, 2 months without a paycheck. Then he goes into retirement and strategies. And then as you progress in life, right, having college fund for your children, paying off a mortgage, and building wealth and being able to give back, right, is a lot of people's ultimate goal. Okay. And then this just goes through doing a quickie budget, right? That you want to take your monthly totals, then take your payoff totals, how far are you behind, what types of account are they, and prioritize them. So if you do have debt, you have a way of working on it, and you're focusing on it, right? Because if you just let it sit there, it's not going to go away, right? You have to kind of face it head on. And if you're not in debt, are you making a plan to ensure that you have savings, right? Because what we'll say, oh, my car broke down, it's an emergency. Well, technically, it's not really an emergency because cars break down. It's just a matter of when, right? So if we plan for it ahead of time, then it's not an emergency for us if we can do that. All right. And then this slide just goes into how you would create a bucket, right? And I mean, I'm sorry, a budget. And I call them buckets of money. So each little representation is a recommended percentage, because sometimes people are like, well, how much rent can I really afford based upon my income, right? And so how much should I spend on food? How much should I spend on transportation? So depending on your budget, these are type of ranges that you should use as a percentage of your income of how you should be allocating, right? So that's why they tell you if your car is like 60% of what your income is, you're probably in a bad situation, right? Or they call it house poor. If your mortgage is more than 25% of your income, it's going to be hard for you to do other things, right? It's hard to have a car insurance, gas, and have extra money when you have all these, most of your money is tied up already into a fixed expense. And then the last subject I'm going to talk about, and before I pass it over to John and Izzy to focus in on credit, is credit card crumbs. And in that area, thank you, my dear. It just talks about the fact that the total American consumer debt is about 2.7 trillion, right? That's a lot of debt on things. Your average household credit card debt has increased from 16 to 167% in the past 17 years. So what does that say? It's very difficult for you to save and to put money away and to be comfortable when you have so much money tied up in things. And most people, and I've been here myself, when I paid my credit card bill, if you ask me, how did I get to that number or what was driving it? A lot of times I don't have an idea, right? So what they recommend is spend cash. I know it's difficult. I went somewhere today to pay for something and they were like, we're not taking cash. And I was like, what? Because like, it's like for a person who budgets, you want to spend cash because the brain doesn't necessarily recognize a card as cash, right? So I do a little scenario with some young people that I mentor, and I give a few of them $100 bill, and I give some of them credit cards. And at the end, I ask for the things back. Never once, right? And partly because it has my name on it, you might feel, oh, I can't use it, but there's no hesitation to return a credit card. The mind technically doesn't associate it as spending. But every person with $100 bill is negotiating with me to keep it. And it's not usually like simple negotiations. It's like, oh, but I thought I got to keep it. You asked me to hold it. I thought I got to hold it forever. It's a lot of backwards and forwards because the mind recognizes it as spending. So if you're in a situation where you think you may overspend or you may use your credit cards too much and you don't realize, hey, what did I spend all this money? One of the things I'd use from Dave Ramsey was to use a little wallet, and it had little envelopes in it, right? And they call it the envelope system. And in each envelope, you allocated money for specific things. So for groceries, say it's $200. For gas, it's $150. For whatever it may be, you're allocating a certain amount of money. And I'll tell you, 9 times out of 10, when I got close to the end, when I went to Publix, I was way more concerned about what I was buying at Publix, right? I wasn't buying every BOGO because I am a Publix BOGO lover. I'm like, we might eat those 8 packs of cookies before the next, buy one, get one free. But when you're more conscious of spending the cash and how much you readily are using in front of you, you're more inclined to spend less and to save more. The card lets you say, well, I'll figure it out later, right? And then a lot of times we wind up, we've way overspent because we've had that kind of later philosophy. Right. So this is just some tidbits on credit cards. We won't read through them all, but with that, I'm going to turn it over to John and Izzy.
We're going to be talking about credit and we're going to talk about the 5 C's of credit to help you guys understand what credit is, how to build credit, maintain good credit, and how it would help you in the future. So to get started, I'm actually going to cover the first C, that is character, that covers credit and also the credit report. Definitely, I think we can probably all relate that when we start building our credit, unless we have somebody guiding you and telling you, you know, what it is and helping you establish that record, we all, you know, have a couple of bumps on the road and have to learn the hard way. And that's one of the reasons why we wanted to cover this topic with you guys today, because it's something very important that's really going to, you know, help you in the future. So to answer your question about cash advance, think about a loan. So a cash advance, when you take out a cash advance from a credit card, you're taking out like a loan from that credit card, and higher interest rates apply to that when you take out that cash, as well as depending on the terms of your credit card, it could be like a fee, a percentage of the amount that you take out, or it could be like a one set fee, not a percentage. So it depends on the terms and conditions of your credit card. But definitely, you know, if there's a need to take out a cash advance from a credit card, make sure that you're, you know, paying it back on time to avoid any, you know, high fees, late fees, or higher interest rates as well. So let's get started on the topic. So for those of you that may not know exactly what a credit score is, I'm gonna start with the basic to explain a little bit about what credit is and the difference between the credit score and how it's calculated, the difference between the credit score and the credit report. And then we're gonna go into, you know, what the numbers mean, because there's a scale for the credit, right? It can range from 300 to 850, or depending on the, you know, the way that you're measuring the credit, sometimes it can go up to 900. So that could be a little confusing, just to give you like a clear picture of what the numbers mean. And then also talk about how we can build credit from scratch, and then some credit moves that can help us to build good credit. So we'll be covering that in a little bit. And of course, if you have any questions as we're going through this information, feel free to ask at any time. So to begin with the credit score. So the credit score is a number that pretty much says how responsible you are managing your financial obligations. So it is a number that lenders use when you're applying for a credit card, when you're applying to get money, right? Whether it's a credit card, whether it's a car loan, a home loan, or even now to apply for a job. A lot of times when you apply for a job, they check your credit score. There's the statistics is that 30% of employers in the US look at the credit because it, you know, it gives some information about the individual that's applying for the job as well, especially if you're applying for a job where you're going to be handling money or sensitive information and things like that. So credit is very important. Also, if you're going to apply for an apartment, to rent an apartment, the landlord will probably run a credit check on you to make sure to see what kind of tenant you would be. If you pay your bills on time, or if you're the type of person that's always paying late, then, or if you're always running behind, you know, on your bills, or you don't pay them at all, you have accounts and collections, then they might want to stay away from renting at the place to somebody who, you know, who doesn't have good credit history, because what that means is that they might not pay their rent, or they might always pay it late. So it's very important to keep an eye on your credit, because it can, you know, affect you in many different ways, depending on, you know, your financial plans and your for your future. So with that said, there isn't really a single formula for you to, you know, get started on your credit. But I'm gonna break down the 5 things that contribute to building a healthy credit score. So the first one, before, you know, lenders can lend you credit, they want to know if you can pay your bills on time, right? And it could be challenging, because when we're starting, if we don't have any credit, but we want to build credit, how can we do that? It's kind of like the chicken and the egg, like which one comes first? Like for me to be able to build credit, I have to have credit, but I don't have, to have credit, I have to build credit, right? So one of the things that you can do is have a bank account, right? Building a history with your bank can help you to, if you're managing your bank account well, even though the bank account doesn't report to the credit and doesn't establish credit for you, you build a relationship with the bank. And depending on how you're managing that account, the bank can actually, see you as a trustworthy person and lend you, give you the opportunity to start a credit card with no deposit. Or in some cases, like Adonis mentioned, they might ask you for a deposit, and not everyone qualifies to get a secured credit card. It's something that you have to apply for and be approved for. So that's usually when you don't have enough, credit or history with the bank. They want to have that collateral to make sure that if you don't pay, then they can have their money, take it from that deposit that you initially made. The other thing that they look at is the amount owed on the credit card. If we have a credit card with a credit line of $2,000 and we max out the credit card, use all of the money available, then that sends out a message that maybe you're not managing your money well by maxing out the credit card. Also, that can lead to additional fees if you use more than what you're able to. Also, if you don't pay off that balance, then you start accumulating interest on a monthly basis. So it's always good. What is suggested is to use 30% or less of your credit card, which will give you the available balance. You'll have more available balance than what you're using. So that's considered a good habit of managing your credit cards well. Also, the length of the credit contributes to your credit score. The longer that you have credit history, the better it is for you, and the better your credit score will be. Also, types of credit. Do you have credit cards? Do you have loans? That could be student loans, car loans, home loans. So the different types of credits that you have, the credit mix, as you can see on the slide here, also contributes to the credit when you're building credit. And the credit inquiries. Sometimes, you might go to a store, you go to Best Buy, or you go to Victoria's Secret or Macy's, and they're really pushing for you to apply for that credit card. And you go for it, and then every time you go to a different store, you apply for a credit card. Every time you apply for a credit card, that impacts your credit. And those inquiries stay on your credit for 2 years. So it's preferably for you to, like, if you don't get approved for a credit card, wait some time before applying for the next credit card. So that way you don't seem desperate, like really wanting to get yourself into debt by applying so many times and all the time, getting denied. That impacts your credit even more. So be responsible when applying for credit, and make sure also that you monitor your credit report. So the credit report is different from the credit. It's not, the credit report doesn't give you a number, it gives you the history. So it's your financial history. So all of your accounts are listed on there, whether they're closed or open, if you're paying things on time, collection accounts, you can, your personal accounts as well, but everything is financial. So anything, if you have like any records, like a public record, like a bankruptcy or anything like that, will be on there as well. No other type of records, just financial records. And your credit history, personal information, any credit inquiry. So all of that is on your credit report. And that credit report, you can get it for free once a year. Also, if you have a credit card, depending which bank or credit card company you use, they might provide you with details about your credit as well and your credit score, so that you can see how you're doing and see if you have any opportunities And sometimes they even give you tips on how to address those opportunities so that you can build healthy credit. Okay, give me a second, please. Sorry, that's my daughter. We have a bird and they took the bird out. Okay, so, and then to go back to the credit conversation, what the numbers mean, right? If we have a scale, if you're using a FICO score, usually the scale is from 300 to about 850. And anything over 670 is considered good credit. Anything, you know, below that, if it's in the range of 580, 669 is considered fair. Anything below that is poor credit. Or if you're between 740 and 799, that's very good. Or over 800, that's excellent credit. So what that means is that the better, you know, the better the score, the more likely you are to get lenders to approve you for, you know, for loans, and also get a better interest rate. When there's a lower credit score, that means that you're a higher risk for that bank to lend you money. So what they're gonna do is, if they, you know, if they decide to move forward and lend you what you're asking for, most likely they'll charge you a higher interest rate. So that's another cost associated, you know, to not managing your financial wealth. Now, how to build credit from scratch. We kind of touched base on this a little bit, talking about building history with the bank. Sometimes, you know, creating a secured credit card as well. Also, if we have someone that sometimes can maybe like co-sign a loan for us, or add us to their credit card as an authorized user, you will benefit from the credit history, from the, you know, habits of that person, and the credit history, you know, with the credit card that they're adding you on to. The only thing is that person will, you know, have the risk that if you maybe don't pay the loan, if they co-sign a loan for you, or if you're on the credit card with them and you don't pay for what you use, then they're going to be responsible for that debt. So that's a risk that they take, but it's a way that, you know, an adult can also, you know, somebody else in your life can help you build that credit, or you can help somebody, you know, a significant other or a child when you have kids, build their own credit as well. Now, 4 key credit moves that we recommend would be to pay your bills on time and pay them in full. Now, if you can't pay them in full, at least pay the minimum payment, and to pay them on time to avoid any, you know, late fees, or any marks on your credit report. Because if you pay your credit cards late or your loans late, it will start, you know, reporting to your credit, and that impacts, you know, your payment history, which you can see here, it's 35% of your credit. So it has a high impact on your credit. Another thing is consider the tools to help you establish credit, which consists of, you know, checking your account. Also, as I mentioned, taking advantage of building a relationship with your bank as well, especially at the beginning when there isn't credit, you know, for them to be able to lend you, to do a credit card or a loan. Just by having that good history with the bank, a lot of times that's taken into consideration when making that decision to give you credit, as well as considering a secured credit card, which is another great way to start building that credit. Don't use all of your credit, as we already mentioned, which is the credit utilization rate. Usually keeping it below 30% is what is suggested. Although, of course, you know, if you need to use more, you always can. That's why you have the money available. Just make sure that you pay it back. And also check your credit report at least once a year, because that will help you monitor your credit history, make sure that your accounts are reporting accurately. If you see anything that doesn't really make sense or anything that doesn't belong to you, that's a really great way to identify maybe if you were a victim of identity fraud or anything like that, which happens. Somebody might use your personal information, open up a credit card, max it out. You don't even know about it until you check your credit report. So it's good to always, have that, get in the habit of checking at least once a year to make sure that things that are reporting under your credit are reporting accurately. Does anybody have any questions so far? Because I know this is a lot of information.
Yeah, I got a question. Can you guys hear me?
Yes, go ahead.
My question is, somebody told me before that as long as you use 25% of your credit card, that's good. Like only use 25% of your credit card and like wait like a week before like your payment date so your credit score could go up.
So it's recommended that you use 30% or less. So 25% is great. Now, it depends. Credit cards are very tricky. So what's really important, is for the credit card, when the statement of the credit card closes, for it to report that 30% or less. So when that statement gets created, it shows, you're using $300 out of an $1,000 balance, right? And then what your payment that is due would be maybe like $25, or the full amount would be $300. So that's what's important, that what is being reported on the bill when the bill gets generated is 30% or less. Now, if you are very organized and very, good on paying your bills and like managing your financials, one thing that you can do is you can always use more. You can always use more, but just make sure that you make a payment so that when that bill generates, it generates with that 30% or less. So that could be a little confusing, and that's why I wasn't really going into that. But let's say I have a credit card and my cycle closes on the 15th of every month, and my credit card is due on the 31st of every month. Then, or the other way around, my cycle closes on the 31st of every month, and then my bill is due on the 15th of the next month, right? So I'm gonna use my credit card. I maxed it out, but I know my bill closes on the 15th. So what I'm gonna do is on the 13th, or depending, what day of the week, because if it lands on the weekend, you wanna make it a couple of days in advance, make a payment so that when that bill generates on the 15th, it only reports 30%. And then, that's what would be due when your bill is due. But then from that day on, from the next day, because my bill closed on the 15th, so starting on the 16th, I can start using my credit card. I can max it out if I want, but I know before the 15th of the next month, I have to make that payment so that when my bill generates, it shows less than 30%. So that's what's really important, what's being reported, because you don't want to report that you have a lot of debt. If that bill generates and it shows that you're using, $2,000 out of the $2,000 that you have available, what that's going to show is that you have a lot of debt. And if you have a couple of credit cards, you have 3 credit cards, $2,000 each, you're in debt $6,000 every month, even if you pay it in full every month. That's not what lenders are seeing. What lenders are seeing is that you owe $6,000 and maybe you make $2,000 a month, or that goes into the debt to income ratio, which is another part of that we're going to be covering. And actually, John is going to cover that part. So this is a really nice segue to go into that.
All right, well, great share. I love that we spent a lot of time talking about credit score and the credit report, which banks call the character of your credit. So just want to give you John's number of 3 as it relates to credit. So the first thing, and so when you think about 3, it's because 3 is going to be a main number. So when you think about your utilization, you never want to have more than 30%. When you think about the length or the age of your credit, in order to have good or excellent credit, you want to have at least 3 years of credit experience. So here's a trick question. If I've had one credit card and I've had that credit card for 10 years, and then I go and I apply and I get another credit card, what's now the average age of my credit?
2 years.
So I've had it for 10, had it for 10 years, and now
My
I get a
bad.
new credit card.
$5 years.
Yes, 5 years. So every time that you add a new credit product to your credit profile, it then changes the average, right, of your credit experience. So it's something that you want to be aware of, because you might have started with great credit, then you go and apply for a bunch of things and you see your score drop drastically. Well, the reason that it's dropped drastically is because the age of your credit has changed. So yeah, on average, 3 years. Okay. So we want to make sure that we got 3 years, the 30%. The next thing is credit mix. Okay. You want to make sure that you have credit in 3 different portions of credit. So you want a credit card, maybe a student loan, maybe a personal loan or a mortgage or an auto loan, but you want to show that you have different types of experience with credit. So if all of your credit is simply credit cards, it tells banks that you don't have experience, right? So it's going to be harder for you to get that better rate on a mortgage when you've never had experience with a secured debt that is just automatically there. I see a question here in the text chat about, does that apply to commercial credit as well? I'll tell you, commercial credit is a little different because typically banks do not report your commercial or small business credit on your personal credit report unless you default. So if you're a guarantor, because businesses are run by the people that own them or manage them. So if you default, then that negative experience shows on your personal report. Yeah, on another side, and I'm happy to come back and do a segment later on with small business credit. Yeah, there's the small business financial exchange, and then there's the Dun and Bradstreet that banks report to, and it's different than what your credit report or your credit score would show. So yeah, just wanted to share that those numbers of 3, they matter, and then you should never have more than 3 inquiries at a time, and that is subjective. Like if you're buying a home, you may have 4 inquiries where you are out loan shopping. Yeah, but that's different. When I say you shouldn't have more than 3, it's if it's the holiday season and you go into Target and then you go into Macy's and then you go into Victoria's Secret, you shouldn't be applying for that credit card in all 3 of those establishments, because that shows banks that you're needy, right? No one likes needy people, but it means that you need a ton of credit, right? And so it talks about your history. So just wanted to add that around score and report. One last thing. Yes, credit score is important, but credit score is not the end all be all. So if I am a senior in college and I have a 4.0, Patrick is a freshman, he has a 4.0. Who has the higher 4.0?
The senior.
Yes, the senior. I've experienced more. My transcripts are going to be far longer, right? So just because you have a high credit score does not mean that automatically you're going to be approved for a loan. You're going to be approved for a credit card. It's also about what your character says. What does your credit history say about you? And that's what's on your credit report. And you may have a lower credit score. Doesn't mean that you can't be approved. You may have what banks call some compensating factors. So for example, all right, I got hit by a car because of a drunk driver. I was out of work and on disability for 12 months. So I didn't have the income to pay my bills, but I got a lawsuit. I paid those debts off. I can prove that to the bank. Well, my credit score may be low, but if I know that I have a compensating factor and I can explain that and have documentation to prove that to the bank, that what they're seeing on my report is not due to any ill will of my own, but I had some unforeseen circumstances, banks will take that and they will give you a more favorable decision based on your compensating factors. So just want to share that credit score is not the end all be all when it comes to credit. And so I'm very passionate about credit because I spent the last 4 years of my career working with lending managers. So they manage underwriters, also advocating for customers. So people that get declined, me working with bankers to advocate for them to help them gain access to credit. And so that takes us into capacity. So we're still talking about the 5 C's of credit. So Molly, you can go to the next slide. And capacity really talks about your ability to repay. So now we're focused on you're walking into a bank or you're walking into a car dealership, and you want to be approved. And so that's what the rest of the 5 C's focuses on. The first thing is your credit character. We've discussed that. But they also look at your capacity. Can you repay? Now, that includes a couple of things. One, your income. Not just that you have income, but how consistent has that income been? So have you been working on the same job for a long time? Maybe you got a new job, but you've been working in the same industry. That matters to lenders, especially when you're trying to get financing for something like a home. So there is a difference between your gross monthly income and your net monthly income. So typically you go into a bank, you want a loan, they say, hey, how much do you make a month? Yeah, most of us, we think about the paycheck that we bring home. How much do you make a week? We tell them what we get on our paycheck. Well, that's the incorrect number to give the bank or any financial institution that might be financing for you, right? If they ask you, well, how much do you make? You want to tell them how much you make hourly if you're an hourly employee, how much you make annually if you're a salary employee. You also want them to include the bonuses that you make. And if you make overtime, you want them to include the average amount of overtime that you make every month. Most of them don't ask you that, but you want to share that with them because what the bank is trying to do or the financial institution is trying to do is calculate your debt to income. And so what your debt to income is we take all of the debt that you owe, so all of your liabilities, not including gas and food, so your rent, your car note, if you have student loans, if you have a mortgage, and then all of your credit card debt that you have, and they divide that by your gross monthly income. This gives them your debt to income ratio, which tells them your ability to have money at the end of all of your bills to repay this loan that you're about to take out. That's your capacity, your ability to repay. Yep. 35% is a really good debt to income ratio. Between 36 to 49%, you got an opportunity to improve. Anything 50% or more, you need to take some action with either decreasing your monthly debts or increasing your monthly income. And capacity to repay at times can get a little tricky because maybe you're sharing the rent with someone. Well, if you don't tell them, well, I share the rent with my brother, they aren't going to take into account that you're only responsible for half of that monthly debt. So I'm going to pause here before we move to collateral and see if there are any questions around capacity. All right, awesome. So let's talk about the next C of credit, which is collateral. So collateral is typically associated with secured debt. So secured debt means that the bank or financial institution is going to have something that they can hold on to if you don't make your debt payment, right? So secured debt are a mortgage, a home equity line, an auto loan, a CD, savings secured loan, a secured credit card. And so these debts typically come with a lower interest rate. Now, why do you think secured personal debt has a lower interest rate? Yes, because of the collateral. So if you don't pay them back, they will come and take your house. They will take the money that you put down for your credit card. They will come and repossess your car. And so it's less risk for the institution because they know that if you don't pay, at least they can come and get something. So that's why secured debt typically has lower interest rates. So Rent-A-Center is a form of you making a payment for something. And if you don't pay them, they just come back and pick it up. Yes, you're absolutely correct, because in some cases, Rent-A-Center is reporting to the credit bureau that you have some account with them that you're making a payment on. Really good analogy there. So for those of you that are thinking about a business or you're going into the medical field, on the small business side, there are some other forms of secured debt. So for example, there's something that's called practice finance. So say you're becoming a dentist or a physician or something that requires a license. Some financial institutions will give you a loan based on your license. So they put a lien on your license to practice. So if you're Alexi, they will take your license to practice law, put a lien on it, and if you don't pay back your loan, they'll have your license revoked, right? So this is ways that small businesses that might just be starting find ways to get funds, is by leveraging other forms of secured debt. Unsecured debt is all of the other debt that's not secured by anything. So think of your student loans, because they can't come back and take your degree. So student loans, your credit card debt, and your medical debt. So collateral type debt, so secured debt, typically helps people that are building credit, because you can start with a secured loan or a secured credit card. The good thing about secured debt is when it ends up on your credit report, it doesn't read secured credit card. It simply reads that you have a credit card. And so it doesn't matter that it's secured. When other banks and financial institutions look at your credit report, it simply says that you have a credit account, which is a benefit for you, because it doesn't tell them that you had to use your own money in order to get started with credit, which is a benefit.
I have a question.
Yes.
With the secure card, and you got to put money down. Say you don't want the credit card no more. Can you get your money back?
Yes. So if you owe no balance on the credit card and you have paid off everything that was on there, and so now you're back at your $300 available, you can close the card and they will send you a refund for the funds that you put down to secure. Here's a bit of advice. If you're thinking about closing a credit account, I would caution you, because closing credit accounts could negatively impact your credit score and your credit profile, right? Because you close that card, you're going to lose the active age of that card. So I started my credit maybe 20 years ago, and I still have the secured credit card that I got with Capital One for $300 when I first got my credit card. It's still in my wallet. I never use it, but it's my secured credit card, and that was the first card I ever had. I've never closed it. So just be cautious about closing the card. Remember, it's an investment in you, and if you need the funds, they're there for you to use and pay back. And then many times institutions will also graduate your card If you've had it for a long time, they'll graduate it and then send you a check back in the mail for what your initial deposit was. Debt to income is gross and not net because everyone's net is different. So for example, I have my medical insurance, my daughter's medical insurance, my wife's medical insurance, my life insurance, my legal insurance, all coming out of my paycheck. So it looks like I make no money after they take out my 401k, Medicaid, Social Security, all that stuff comes out. Even I wonder, where's the rest of my money, right? And so for us to make sure that we hold everyone to an even playing field, that's why we use gross, because some people don't pay for health insurance. Some people don't save for retirement. So is it fair that you hold me accountable because I'm using my money other ways before I get my net paycheck and Molly doesn't use her check that way? Well, no, that's not fair. So to make it an even playing field, we look at gross income.
Thanks, John.
You're welcome.
I just think it leads people into more debt, but that's for a separate conversation because, yeah, we'll have a conversation offline so I can get more clarity.
Absolutely. All right, let's talk a little bit about capital. So what is capital? Again, we're talking about the 5 C's of credit when you walk in a bank. Capital is what lenders use to evaluate, your ability, again, to repay. And capital is simply the money that you have elsewhere. So do you have money in a savings account? Banks love to see that. It tells banks that if you lose your job, in order to pay your bills, you will start using the capital that you have to pay your monthly bills. The other thing is you might have a 401k, you might have investments, which are liquid, but they aren't instantaneously liquid. But banks like to see that you have some form of cash saved up somewhere else. Again, it tells them that if you hit tough times or an emergency, that you would start to leverage the cash that you have to pay your monthly bills, right? And so if you don't have any cash on hand at all, and you're looking to get a mortgage, it's probably going to be very difficult for you because the bank wants to see that you can at least, if you had a month-to-month crisis, be able to make your mortgage payment. If you can't, then the bank has to repossess the home. And contrary to many beliefs, banks are not in the business of selling homes. They want to finance them to make money. So when a bank repossesses a home, they actually lose money and not gain money. So capital is another thing that they look at. Do you have funds outside of what you're requesting in case of an emergency? All right, we got one last 5C. And so this is the last boring piece, but then we got some great graduation stuff that's coming up. So hang tight. So the last C is conditions. And conditions includes a lot of things. So market conditions, the rate, and the term. Let's talk about rate and term first. So the term that you request, and so now we're talking about loans, not credit cards, talking about loans, personal loans, home loans, auto loans. So all of them have a term, and there are 2 types of rates that you could have, which is either adjustable or a fixed rate. A fixed rate means that your rate will never change, irregardless of what happens, it will never change. And then an adjustable rate means that it's going to fluctuate based on prime. So with an adjustable rate, it's based on prime, which is the floor rate of what the Wall Street Journal posts. So prime plus something, plus whatever the financial institution has. And as prime increases or decreases, you're going to pay more or less. Typically, credit cards are on an adjustable rate. So that's why you will start to see your credit card statement, the monthly amount that you owe either go up or down. And you'll hear a lot of people from financial institutions talk about the feds. The feds have raised the rate. That means that the floor rate has increased. The feds have decreased the rate. That means that the floor rate has went down. The highest that the Fed rate has ever been is somewhere around, I think, 18.73%. And so I know this because I used to teach a home equity class, and I would use this as like a fact. How high do you think it's ever been? So you would be paying 18 point something plus whatever the rate is that the bank is charging. So if it's 18 and the bank is charging you an additional, let's say 10%, your rate would effectively be 28%. And again, it changes as the Fed rate fluctuates. If it goes up, you suffer. If it goes down, you benefit from it going down. All right, so the term helps to impact the rate. The longer of a term you have, so meaning the longer amount that you choose to repay. So let's say, for example, a personal loan. Typically, the term is 12 months, 24 months, 36 months, 48 months, 60 months. A 60-month term is going to make your rate much higher than a 12-month term. Why do you think that is?
Because there's more risk that you're not going to pay over time.
Yes, I'm the bank. I got to trust you for a longer period of time. Okay, so if I'm going to lend Patrick $5 today, he says, I'm going to pay you back on Sunday. I can trust him to do that. But if I lend him $5 today and he says, hey, next year when we do this again, I'm going to pay you back, the likelihood is that he may forget by next year and not pay me back. Right. So I want to charge Patrick more interest, right? So that he is eager. And that way, if he doesn't pay me back, I've gotten some of it back because interest is typically paid on the front end of a loan. You start to pay that interest off the top. And then as you start to pay it down, then you get to paying the principal balance that you owe down. So that's why if you choose a longer term, then you're going to end up paying a larger interest rate. Some other things that impact conditions are the conditions of the economy. So when the economy is not doing so well, it's going to be really, really hard for you to get lending, right? So if you got bad credit or okay credit, and the conditions of the economy isn't well, people are defaulting a lot. Typically, banks take that into consideration and they either may or may not make exceptions that they otherwise would have made to extend lending to customers. The other thing with conditions is, what are you using the money for, right? So at the bank, we get people that want personal loans because they're going to go and put $5,000 in GameStop. Okay, that's a red flag. Do you have any investment experience? No, I don't have any investment experience. So how are you going to, I'm just going to put it into the stock market. Well, that's very risky, right? And so the bank doesn't want to take on that risk of someone that has no investing experience going to get a loan to take and throw in investing when they have no experience in investing. So what you're going to use the funds for is just as important as your credit history. And those things make up conditions. So we've done a brief overview. We've covered quite a bit of the 5 C's of credit. But the good thing is that when you know what the 5 C's of credit are, and you can tell your 5 C's of credit story with what we've provided you today, you can put together your story, walk into any financial institution, and almost check the person that's doing the work for you, right? So if you've pulled your credit report, you know what your credit history is, and your score might not be the best, but you know your history is solid. You got John rules of 3 all in the wrap. You can go in and say, yes, I know that my credit score is a 675, but let me explain to you a little bit about my credit history. Never missed a payment. Yeah, I have a nice credit mix, right? You can start to explain that. Those are the things that underwriters consider. So this is the language of underwriters that we've shared with you today to help prepare you for when you either go to buy that first car, you go to get that first personal loan, you go to buy that first condo. These are the things that financial institutions are considering.